Debt, when used wisely, can be a powerful tool for generating wealth. Many wealthy individuals leverage debt strategically to grow their assets, invest in opportunities, and manage their financial portfolios. Here's how the rich use debt to their advantage. 1. Real estate investments. Rich individuals often use mortgages to buy rental properties or commercial real estate. By leveraging debt, they can acquire larger properties with a smaller initial investment, earning rental income and benefiting from property appreciation. 2. Business expansion. Successful entrepreneurs use business loans to expand their operations. This could involve purchasing new equipment, opening new locations, or investing in marketing campaigns. The return on investment from these expansions often outweighs the cost of the debt. 3. Tax deductions. Interest payments on certain types of debt, such as mortgages and business loans, can be tax deductible. Wealthy individuals often use this to reduce their taxable income and lower their overall tax burden. 4. Leveraged buyouts. In private equity, wealthy investors use debt to acquire companies. They use the acquired company's cash flow to pay down the debt, aiming for a high return on their equity investment when they sell the company. 5. Stock market investments. Some affluent investors use margin accounts to borrow money for investing in the stock market. By leveraging their investments, they aim to amplify their returns. However, this strategy comes with higher risk and requires careful management. 6. Real estate development. Debt is used to finance large real estate development projects. Developers borrow money to cover construction costs and then repay the debt through sales or rental income from the completed properties. 7. Refinancing. Rich individuals often refinance existing debt to secure lower interest rates or better terms. This can free up cash flow, reduce overall debt costs, and improve investment returns. 8. Private loans. Wealthy individuals may lend money to businesses or other investors at a premium, earning interest income. This can be more profitable than traditional investments, especially if the borrower is a high-risk, high-reward candidate. 9. Creating leverage. Using debt to create leverage allows investors to control larger investments than they could with just their own capital. This leverage can amplify both potential returns and potential losses. 10. Arbitrage opportunities. Debt can be used to exploit arbitrage opportunities, where investors borrow at a low interest rate, and invest in assets that offer higher returns. The profit from the difference between the two rates can be substantial. 11. Venture capital. Wealthy investors in venture capital use debt to fund startups with high growth potential. The high risk is mitigated by the potential for substantial returns if the startup succeeds. 12. Buying income-generating assets. Debt is often used to acquire assets that generate regular income, such as dividend-paying stocks, rental properties, or royalties. The income produced can be used to service the debt and build additional wealth. 13. Leveraged real estate syndication. Rich individuals participate in real estate syndications where debt is used to finance large projects. They invest a portion of their own money and use leverage to maximize the returns on their investment. 14. Strategic borrowing. For opportunities. When a lucrative investment opportunity arises, wealthy individuals may use debt to quickly secure the asset. This can be particularly effective in competitive markets where speed is crucial. 15. Funding personal projects. Affluent individuals may take out loans to fund personal projects or ventures, such as starting a new business or investing in high-value collectibles. The returns from these ventures can far exceed the cost of the debt. 16. Leveraging retirement accounts. Certain types of retirement accounts, such as self-directed IRAs, allow for borrowing against the value of the account. Wealthy individuals use this strategy to invest in real estate or other opportunities without fully withdrawing funds. 17. High-yield investments. Debt can be used to invest in high-yield opportunities, such as high-interest bonds or private equity deals. The goal is to generate returns that exceed the cost of the debt. 18. Credit card rewards and financing. Rich individuals may use credit cards for large purchases to earn rewards or cash back. They then pay off the balance in full before interest accrues, effectively using the credit card as a short-term financing tool. 19. Leveraged buy and hold strategy. This strategy involves using debt to acquire assets, such as stocks or real estate, with the intention of holding them long-term. The value of these assets is expected to increase over time, generating wealth and covering debt costs. 20. Building business credit. Wealthy entrepreneurs use debt to build their business credit profile. A strong credit profile enables them to secure better financing terms, invest in growth, and manage cash flow more effectively. By understanding and strategically using debt, wealthy individuals can leverage it to build and sustain their wealth. Each of these methods requires careful planning, risk management, and financial acumen to ensure that the benefits outweigh the costs. Understanding the risks and rewards of leveraging debt. Debt can be a powerful tool for growing wealth, but it comes with inherent risks that need to be carefully managed. Leveraging debt effectively requires a deep understanding of both the potential rewards and the risks involved. Assessing risk tolerance. Before using debt as a strategy, it's crucial to assess your risk tolerance. This means evaluating how much risk you're willing and able to take on, based on your financial situation, investment goals, and market conditions. High levels of debt can lead to significant financial strain if investments do not perform as expected or if interest rates rise. Understanding interest rates. Interest rates play a critical role in determining the cost of debt. Fixed rates provide stability, while variable rates can fluctuate with market conditions. It's important to understand how the interest rate on your debt compares to the potential returns on your investments. Ensure that the expected returns are high enough to cover the cost of borrowing and provide a profit. Managing cash flow. Effective cash flow management is key when using debt. Ensure that you have a clear plan for how you will generate enough income to cover debt repayments. Regularly monitor your cash flow to avoid shortfalls that could lead to missed payments and financial difficulties. Diversification of investments. When using debt to invest, diversification can help manage risk. Spread your investments across different asset classes to reduce the impact of poor performance in any one area. This approach can help mitigate the risk associated with high levels of debt, and increase the likelihood of achieving positive returns. Monitoring financial health. Regularly review your financial health to ensure that debt levels remain manageable. This includes keeping track of your debt-to-income ratio, net worth, and overall financial stability. Adjust your debt strategy as needed based on changes in your financial situation or market conditions. Debt repayment strategy. Having a clear debt repayment strategy is essential. Prioritize high-interest debt and develop a plan to pay it off as quickly as possible. Consider using strategies, such as refinancing to lower interest rates or consolidating multiple debts into a single loan with better terms. Legal and tax considerations. Be aware of the legal and tax implications of using debt. Different types of debt have different tax treatments, and it's important to understand how interest payments and debt-related deductions impact your overall tax situation. Consulting with a financial advisor or tax professional can provide valuable insights. Long-term planning. Consider the long-term implications of using debt. Assess how your debt strategy aligns with your long-term financial goals and whether it supports your overall investment plan. Ensure that your approach to leveraging debt is sustainable and aligns with your future objectives. Exit strategy. Have an exit strategy in place for when investments do not perform as expected or when market conditions change. This might involve selling assets, reducing debt, or adjusting your investment strategy. A well-thought-out exit strategy can help minimize losses and protect your financial well-being. Continuous education. Stay informed about financial markets, investment opportunities, and debt management strategies. Continuous education can help you make informed decisions and adapt your debt strategy to changing conditions. Seek out resources, attend seminars, and engage with financial experts to enhance your knowledge. Leveraging debt effectively requires a balanced approach that combines careful planning, risk management, and ongoing education. By understanding and managing the risks associated with debt, you can use it as a tool to enhance your financial growth while minimizing potential downsides. Evaluating debt opportunities. Key considerations for smart borrowing. When exploring debt opportunities, it's essential to thoroughly evaluate each option to ensure that it aligns with your financial goals and risk tolerance. Here's how to make informed decisions about borrowing. Identify your financial goals. Start by clearly defining your financial objectives. Whether you're looking to invest in real estate, start a business, or fund other ventures, understanding your goals will help you determine the type of debt that best suits your needs. Different goals may require different types of loans or credit lines. Research loan types and terms. Familiarize yourself with the various types of loans available, such as personal loans, business loans, home equity lines of credit, and credit cards. Each comes with its own set of terms, interest rates, and repayment schedules. Compare these options to find the one that offers the best balance of cost and flexibility for your specific situation. Evaluate lender reputation before committing to a loan. Research the lender's reputation. Look for reviews, check their ratings with consumer protection agencies, and ensure they have a history of fair practices. A reliable lender will offer transparent terms and provide support throughout the borrowing process. Understand the fine print. Carefully review the terms and conditions of any loan agreement. Pay close attention to interest rates, fees, repayment schedules, and any prepayment penalties. Understanding the fine print will help you avoid surprises and make sure you're fully aware of the costs involved. Calculate the total cost of borrowing. Determine the total cost of borrowing by calculating the overall amount you'll repay over the life of the loan, including interest and fees. Use online calculators or consult with a financial advisor to get a clear picture of the long-term financial impact. This will help you assess whether the benefits of the loan outweigh its costs. Assess your ability to repay. Evaluate your ability to make regular payments on the loan. Consider your current income, expenses, and any potential changes in your financial situation. Ensure that you have a plan in place to manage repayments and that the loan fits comfortably within your budget. Consider alternative financing options. Explore alternative financing options that might be more suitable for your needs. This could include seeking investors, using personal savings, or exploring crowdfunding platforms. Sometimes, alternative sources of funding can offer better terms or align more closely with your financial goals. Plan for unexpected changes. Prepare for unexpected changes in your financial situation by having a contingency plan in place. This might involve building an emergency fund, securing insurance, or having a plan for adjusting your budget if necessary. Being prepared for potential challenges can help you manage debt more effectively. Seek professional advice. Consult with a financial advisor or debt management expert to get personalized advice based on your financial situation. A professional can provide insights into the best borrowing strategies and help you navigate complex loan agreements. Monitor and adjust your strategy. Once you've secured a loan, continuously monitor your financial situation and adjust your strategy as needed. Keep track of your debt levels, repayment progress, and any changes in your financial goals. Regularly reviewing your debt strategy ensures that it remains aligned with your overall financial plan. By carefully evaluating debt opportunities and making informed decisions, you can effectively leverage borrowing to achieve your financial objectives while managing risks and maintaining control over your finances. Leveraging debt for investment success, strategies and best practices. Once you've navigated the process of acquiring debt, the next step is to use it strategically to enhance your investment opportunities. Here's how to leverage debt effectively to boost your financial growth. 1. Use debt to diversify investments. Debt can be a powerful tool for diversifying your investment portfolio. By borrowing funds, you can invest in a range of assets, such as stocks, bonds, real estate, or other investment vehicles. Diversification helps spread risk and can potentially lead to higher returns. Ensure that any debt you incur for this purpose aligns with your overall investment strategy and risk tolerance. 2. Invest in high-yield opportunities. Focus on investments that offer high returns relative to the cost of the debt. For example, real estate properties in growing markets or stocks with strong growth potential can provide substantial returns. By choosing high-yield opportunities, you increase the chances of generating more income than the interest expense on the borrowed funds. 3. Utilize leverage wisely. Leverage, which involves using borrowed funds to increase the size of your investment, can amplify both gains and losses. It's crucial to use leverage wisely and avoid overextending yourself. Assess the potential risks and rewards before using leverage, and ensure you have a plan for managing any potential downsides. 4. Optimize debt repayment strategies. Implement a structured plan for repaying debt to minimize interest costs and maintain financial stability. This might include making extra payments, refinancing at lower interest rates, or consolidating debts. Effective debt management ensures that your borrowing remains a beneficial component of your investment strategy. 5. Monitor investment performance. Regularly track the performance of investments funded by debt. This includes reviewing returns, assessing the impact of borrowing costs, and adjusting your strategy as needed. Staying informed about how your investments are performing helps you make data-driven decisions and optimize your investment approach. 6. Consider tax implications. Understand the tax implications of using debt for investments. Interest on certain types of investment debt may be tax deductible, which can reduce your overall tax liability. Consult with a tax advisor to maximize potential tax benefits and ensure compliance with relevant tax regulations. 7. Assess market conditions. Stay informed about market conditions and economic factors that could impact your investments. Changes in interest rates, economic trends, or market volatility can affect the performance of your investments and the cost of borrowing. Adjust your strategy based on current market conditions to maintain a favorable balance between risk and return. 8. Balance risk and return. Strive to balance the potential returns of your investments with the associated risks of using debt. Avoid chasing high returns without considering the risks involved. A well-balanced approach ensures that you're not overexposing yourself to potential losses and that your investment strategy remains aligned with your financial goals. 9. Seek professional guidance. Consult with financial advisors or investment professionals to gain insights and advice on leveraging debt effectively. Professionals can provide tailored recommendations based on your financial situation and help you navigate complex investment decisions. 10. Evaluate long-term impact. Consider the long-term impact of using debt for investments. Assess how borrowing might affect your financial goals, overall wealth, and future financial stability. Ensure that your use of debt aligns with your long-term financial plan and contributes to your overall success. By following these strategies and best practices, you can leverage debt effectively to enhance your investment opportunities and achieve your financial objectives. Strategic borrowing can provide the capital needed to seize lucrative investment opportunities while managing risks and optimizing returns. Don't forget to subscribe in the channel and like the video for more contents.